Hey everyone, welcome back to the Mark Loeffler Experience. Today we're going to talk about how you can buy real estate investments with as little as $1. So if you want to buy real estate for as little as $1, stick around. What exactly is this? Well, it's called fractional investing. It's called crowdfunding. Some people would call it timeshare. A little bit different, obviously, because you are investing in real estate. How does it work? Well, let's get the boring stuff out of the way first. So in Canada, at least, and I'm sure the States is very similar as similar legal systems, it's an LPGP structure. So what does that mean? That's your limited partner. Therefore, you have limited risk. So you're limited to the capital you put in. So if you put in $1, you can lose $1. Where the general partners can lose, if there's a lawsuit, environmental issue, something happens. Anyways, they're the ones that are on the hook. They're also the people who are typically, if they need to, they're the ones that have to co-sign or personally guarantee mortgages. But once you get into big enough real estate, that's actually not happening anymore. There's no more personal guarantees. How does this work and what are they buying? So there's a couple things that I've found, I'm going to talk about two different ones. So the ones Addy Invest, you can, again, invest as little as $1 and as much as $1,500. They own properties in Toronto, Hamilton, St. Catharines, Calgary, Vancouver. Yeah, they're all over the map of what they own. They own residential buildings, they own mixed use, industrial parks, they own trailer parks. Basically, if it makes money in real estate, they're going to probably do it. So you're like, okay, great. I invest my dollar. How does that work? Well, so first off, you got to pay a $25 membership fee to be part of Addy, which, okay, it's fine. Now, they don't take any fees. So there's no acquisition fees. There's no cost of funds for them. Like to do this, there's no, they don't charge a management fee on this. Obviously, there's a property manager involved, probably a separate business, and there's a fee for that. But that's all baked in, I'm sure, to their operating memorandum, which I haven't become a member yet, and they have no offering right now. So I don't know. But I'm just guessing here. This is just me guessing. And I know, Fuad, you like it when I say I don't know, and I don't know on this because I haven't became a member. I didn't pay my $25. So I guess who are they targeting? The target of this is younger people who want to invest in real estate and yet can't. There are private funds out there that do this. It's just they do it differently. They usually work with accredited investors. If you're not accredited in the past, you had to go to a REIT, and they obviously work a little bit differently than this. You're buying into a portfolio of properties, where this you're buying that specific property. Addy actually doesn't show how they make money, right? I went on their website and you can see that. Let's just go to the about. Like, this is a big business. Like, look at how many people they have on their team. So we have a lot of software engineers. Head of engineering, head of communications, head of real estate ops, CEO, co-founder, director of sales, software engineer, and test. I don't know why they need so many software engineers, but this obviously is a big team, right? So they have to be making money. Some way, somehow, they have to be making money. So typically an LPGP structure, there are fees, or there's like same thing as in a joint venture. It's just a fancy way of doing a joint venture that costs a little bit more money to set up with lawyers. So with that, basically how they make money is they share in the upside of the building or the rent. So if they're buying buildings like I do that need work, like value adds, then they share in that upside. They share in that cash flow. They can obviously either sell that building or reposition it with a different, like a lender. And that's how they're making their money. So it doesn't actually say on here what percentage they take. Is it 50-50? Is it 30-70? I mean, most funds I know are 80/20, yet then they're loaded up with fees. LPGP structure, I know their cost of raising money is around 9%. So they have a 10 to 11% hurdle that they got to clear before they even make money. But these guys, they don't have that. Obviously, they're going direct to investor, which allows them to not have to do that. And then there's another one that I found, Buy Properly, and they actually put out a lot of it how they do it up front. Obviously, they charge a one-time acquisition cost. They do say it's only home inspection and legal fees. Obviously, when we buy these buildings, we have environmentals, we have financing costs. It's just a lot more costly to buy these bigger buildings, which is fine. You're doing your due diligence and you want to get these things done because you're protecting yourself, and obviously they're protecting their investors. Buy Properly also charges an annual fee of 2.5% plus tax on their investment amount. So a lot of these companies will charge an ongoing management fee based on the size of the asset. So if they have $100 million in real estate that they're managing, they'll charge a 2% fee. So that's $2 million a year. And that's typically is how they fund their operations. So their minimum is $2,500. So a little bit different. Like they're probably playing on a little different scale. Basically, the company has 300 investors to date. No single investor can own more than 50% of a house. And this is weird for me because they just buy rental houses. So this picture here that we'll put up here is standing in front of a $2.2 million rental house in Mississauga, Ontario. I mean, I don't know. I find it hard to believe that a $2.2 million home in Mississauga makes a great rental. At least with that Addy company, Addy Investor, whatever it is, like they're buying assets. I know some of the areas they're buying. I know some of the buildings they've bought. And you're like, okay, I can see that. It makes sense. It makes financial sense. So, I mean, obviously you have to do your due diligence on this. It just seems a little weird to me, that's all, with their buying houses. So I'm a little shocked. I mean, what can I say? Guys, tell me, is this a good idea? Would you invest in something like this? This just means you're the silent partner. So same thing that myself and my partners do and my friends, we attract investors. Obviously, this is a lot less of an investment. So like for us, our minimum's like 150. You got to be accredited as per like the Ontario Securities Commission. Yeah, like you don't have to be here. There's that loophole. Like obviously, LPGP structure is different, and I don't go that route. And I'm not a securities lawyer. But this is popping up in the U.S. This is popping up here now. Is this something you guys have looked at? Have you looked at investing? Have you looked at setting one of these up? This is, honestly, it's interesting to me. I think I might have to go down this route. How many of you guys would throw $10 into a property if I said, hey, it's a good deal? I don't know. It just seems really interesting to me. I'm going to pursue this further. I mean, who knows? I mean, maybe I need 5 software engineers on staff. I think I don't understand why a real estate company needs 5 software engineers on staff, but they're obviously doing something that I'm not, and they're buying more properties than I am. So, I mean, good for them. That's all. I'm just going to leave it out there. Good for them. And this might be something I want to look into. I'm just going to put that out there. All right. Comment down below. Do you think this is a good idea? Would you invest in this? Would you run something like this? Let me know down below. Thanks, everybody. Have a great day. We'll catch you next time.